Good morning, students.
Good morning, students.
We welcome you to the first session of Paper 2, Strategic Financial Management. Along with me, my BoS faculty, C. Ashish Gupta and Vivek Banerjee are there with me. And they'll be taking you through to this particular session, which is going to be there today and tomorrow. So students, kindly just note that this is a very critical paper. The topics which are covered over here are something you really need to understand the basics of that. And it is having 80% of the paper is practical based, right? And 20% is theory. So you should be very clear on your theoretical part also. Understand? Because the question will have one part of theory also. So you should combine the practical with the theory, and you should know how to address to the theory part also. You'll be able to address to the theory part if you understand the basics of that particular concept, and then only you will be able to do the practical side of it. Application and analysis is very important in this paper. Understand the nitty-gritties of the paper. Read the question paper very, very carefully. And at times you need to make certain assumptions. So first make that assumption very clear and then start with the answer, right? You are expected to write the assumption and then you start with your practical part. And be very careful that you need to rather give all your steps. The notes should come. It is not that you have done the calculation on the calculator and you have not penned down in the answer sheet. So you need to write down the steps in the answer sheet. Then only you will be able to secure good marks. Okay. So students, I'll apprise you about the section-wise weightage which this paper is having. The section 1, which is comprising of financial policy and corporate strategy and risk management, it is having weightage of 5 to 10%. Section 2 has the weightage of 20 to 30%. And this section is comprising of security analysis, security valuation, portfolio management, right? Then comes section 3, which has a weightage of 20 to 25%. And it is comprising of topics of securitization, then mutual funds, derivative analysis, and valuation. Section 4 is having a weightage of 20 to 25%. It is having topics, namely foreign exchange, exposure and risk management, international financial management, interest, rate risk management. Then comes the section 5, which is having a weightage of 10 to 15%, and it comprises of corporate valuation, merger, acquisition and corporate restructuring, and the last section, which is section 6, is having a weightage of 5 to 10%, and it again constitutes startup finance. So student, we have marked this section-wise weightage, so plan your studies accordingly, but don't try to skip any of the topics. Understand? Because in one question, you may get question from different sections. So if you have done one part of that section and left another two, and maybe the question comes from the other two. So don't skip the topics. It is having limited set of topics. You should be thorough and you are required to know all the topics. Understand? And students, one more thing is that our faculty, C. Ashish Gupta and Vivek, will be taking you through this nitty-gritties of this paper. They'll apprise you how to deal with the questions. In the examination conditions, what are the tips you should have in mind while attempting the question? They'll tell you the problems which students fail while answering the question in this particular paper. So be there, listen to them carefully. Wherever you are having any query, you can post this query now. They'll be taking up your queries also. In case after the sessions, if you still have the queries, you can always post your queries on the Ask Your Query section in the BoS mobile app. Students, if you have not downloaded the BoS mobile app, do download it. It is available in Android version also, and it is also available in the Google Play Store as well as in the Apple Play Store, and you can download the same depending on the mobile which you are having. So accordingly, you can download that app. You will get everything in the mobile app. All the BOS initiatives, everything is available over there. Ask your query section is also over there. You must clarify your doubts. Don't go to the exam with some doubts in your mind. If you have doubts, you will not be able to attend the question properly. So students, be very careful in understanding the topic and how to attend the questions. And students, these sessions are going to continue till 26th of September. And after 26th September, we are going to have 2 mock test paper series. So students, you are advised to attend these mock test paper series, which will help you in getting yourself accustomed to the exam conditions. Read the questions in the mock test. If you are able to go to the branches, you go over there, attempt the question paper in the examination conditions. Thereafter, our answers for these particular mock test series will also be uploaded. It is after one paper is uploaded, the answer is getting uploaded within 48 hours. Attempt the question, see the answers, and see where you have gone wrong. I'm telling you, this is really going to plan for your paper of 3 hours. And as to how, Ashish will be telling you specifically how to use the 15 minutes time also before the exam. So be there with our faculty. They are there for you. They are always there for you. Attend the sessions. Tell your peers also, if somehow you are not able to attend the session, you can see the recorded version also. But my advice to you is to attend the live session so that your queries also get resolved. Right. Thank you, students, and all the best. Enjoy your learning and you will do best. I am handing the mic to my faculty, Ashish Gupta and Vivek. Welcome, Ashish and Vivek.
Thank you, madam. Thanks a lot. Good morning, friends. I, C. Ashish Gupta, Deputy Director, Board of Studies, welcome you all in this session on BoS for Your Success. As our Director, Board of Studies, has already briefed about this paper, so with me, CS Vivek Banerjee, although you must have visited, if you have referred our lecture, so you must have seen him there because earlier he was a freelance. Now he has joined the Board of Studies. So welcome, Vivek.
Good morning, everybody.
And so we shall both of us will take discuss the what are the basic character of this paper, and what is more important in this paper is students. Today this is a very lengthy although the topics are many, so we cannot take up any single topic, but we will give you a broad overview of the syllabus, and for each topic what is its importance and how we have to go by the same, we all discuss shall be covered here. So first of all, let us discuss what is the overview of the syllabus. Students, it is well advised to all students that whenever we take any examination, what is the basis of the paper setting? So paper setting is basically the basic syllabus. Syllabus is the base of every paper. Now when we go for syllabus, first we go what is expected from the student. So this is the first overview of the syllabus, that is to acquire the ability to apply financial management theories and techniques in strategic decision making. As the name of the paper or nomenclature of the paper is that strategic financial management. So students, here we shall learn how we can apply financial management techniques in making strategic decision making, because nowadays chartered accountants are becoming CFOs of the company. Not even CFO, they are upgraded to the level of CEO also. So strategic aspect has also become an important part of the curriculum also. So students, let us start one by one topic. Now first topic is the financial policy and corporate strategy. Student, this topic is basically a theoretical topic, of course, and theoretical questions are asked. But sometimes what it has been observed that although students say, sir, it is a very dry topic. Of course, it is a dry topic. But if you read between the lines, you will realize that it is not a dry topic. Rather, it is more close to your practical application or more close to your strategic decision making. Now, when we start with the strategic decision making framework, we have to see what are the strategic decisions that normally taken in our corporate world. For a strategic decision making, there should be clear and realistic strategy. We should have a financial resources with us, and it is very important that the right management of the team and the process. These are the three pillars are there. Now, what is strategy? Strategy I know to define here because you must have studied at your intermediate level. Now, I am straightforward coming to the meaning of the strategic financial management. Now, strategic financial management means the application of financial techniques to strategic decision making to achieve the organization objective, and it is very important that it is combines the backward looking as well as forward looking. Now backward looking means it is basically concerned with the numbers. It is concerned with the numbers that are provided by the back office, that is the financial accounting and the financial reporting. And forward looking, it means that is it is a dynamic in the nature that we have to look for the various opportunities in the world, because today the world is dynamic. Every day new techniques are coming. You must have listened about the blockchain technology, artificial intelligence, data analytics. So time is changing. We have to upgrade ourselves to the changes. And one very good example always I quote regarding the forward looking or dynamism is the example of a very famous company. If you have heard the name of the photography, Kodak. Kodak is a very good example because they have not upgraded themselves to the digital pictureography. Although they have first initially they have started this electric version, but they have not upgraded themselves, and as a result, the company has bankrupt. So it is very important that you have to see what are the dynamism of the today's world, so that accordingly you can change yourself. Now next it comes it involves the allocation of scarce resources among the competitive opportunities. Now, student, here the economic applies where we have limited resources and our wants are unlimited. Likewise, in the financial management, if you have referred the topic of capital budgeting, there we have a topic capital rationing. Now, in the capital rationing, we have a limited funds, but we have different ample opportunities. Now, it is our, you can say, wisdom, or it is our thought process that, or we have the decision making power, strategic decision making power, that we have to allocate the resources in that manner that our maximization of the wealth of the shareholder, because ultimately it is the objective of the financial management. Now, next is it encompasses the implementation and monitoring of the chosen policy so as to achieve the agreed objective. Now, here the control aspect comes into the picture. Of course, you have made a very good strategy. You have got implemented. Now, its evaluation is very important, because with the passage of time, is any change is required, because sometimes what happens, even when we go in every office or in a day-to-day life, suppose, because if you are driving a car, suppose you are driving a car, but after 6 months or 1 year, you have to make it take your car to the service station for a regular checkup, because you want to ensure that it should not be get breakdown in the way, between the way. So similarly, when you implement any policy, that you have to see that whether it should be monitored closely and so that it is going on well or not. If any changes are required, of course you go for the same. Now, next we are comes, what are the key financial decisions are taken under the scope of financial strategy. Now, so first is our financing decision, which source of financing we should apply, that is share, equity share, debenture, preference share, retained earning. Now new concepts are coming, private equity. Now, students, the days are gone when traditional sources of finance used to be there, but now the different sources like private equity, and that's why our private equity has been covered in our topic of startup finance, because now is the time is of startup finance. So we have to see what are the different sources, and I think angel investing is also there. These are the new sources. CS Vivek Banerjee will throw the light in a more detail on this topic. Next is investment decision. Now, as usual, investment decisions can be of two type. One is your capex, another is your working capital management. Capex means capital investment decision. Capital investment decisions means capital budgeting, because these are those decisions, once they are taken, they cannot be reverted back, because huge commitment are involved and huge resources are involved. The another decision that is normally come under it is working capital management, although it is a part of investment decision, but working capital management is somewhat is a short-term decisions. So you have to think how much we have to invest in the working capital so that our business operation should be run smoothly. And under the working capital management, there are receivable management, there are inventory management, there is a cash management, and then is a payable management also is there. So accordingly, we have to see, because working capital means current assets minus current liabilities. Our debtors debtors plus cash plus inventory comes on under the our current assets head, and accounts payable come under our current liabilities head. Accordingly, we have to see that how much invest we have to make and what decisions have to be taken. Now, next is our dividend decision. Once we have finance source has been identified, we have made the investment, returns are coming. Now it is very important how we allocate this resource surplus. Now, of course, our some fixed commitments are there, like our interest on debentures, preference shares, dividend, fixed dividends are there. But when it comes to the balance earning, residual earning, now it depends how much dividend we have to distribute. Now, in this scenario, the dividend decision comes into the picture. Okay, so company has to see, because they have to balance out. They have to balance out how much dividend we have to distribute, because after that, after I think 5 to 10 minutes, I will take you the concept of sustainable growth rate. So that is relating to your ultimately dividend decisions, because whatever the earnings are there, how much you will retain, it is very important. Okay, it is very important that how much you are retaining, It is very important because once you are retaining the funds, you are plowing back the same, and that's why you are getting the growth. So, of course, there are some queries also. Students, please have some patience. I will take these queries. Now, next comes our this is portfolio decision. Last is our portfolio. Now, student, portfolio decision means we have to decide what because now at times has changed. Okay, if we say concentrate our efforts on only one product or one line of business, maybe if the with the change in circumstances the line may not be profitable. So in that case, the portfolio decisions, or you can say it is a kind of a diversification, help us to achieve our business objective. Now, next is comes our there are three strategies at different level. I am not going into the nitty-gritties. These are corporate level strategies, business unit level strategies, and functional level strategies. So all these are coming come there. In the last, I am coming to the financial planning. Now, student, financial planning is an important aspect of the strategic decision making because we have to decide how much fund we need. And under this category, I think in January 2021, one question has been asked from the topic external funding requirement. Okay, external funding requirement, because as I told you, when we have got a surplus with us, so some surplus will be plowed back, and and some surplus we shall distribute. Now question comes, how much, suppose if a company wants to go for a new project, now question it requires that, or we say that company is growing. Okay, now when company is growing, of course there will be needed some additional investment. For this, how to finance this additional investment, it is a part of financial planning. And for financial planning, normally we say, okay, some part will be financed by our retained earning. Now balance will be external fund requirement, how much funds we shall get from need from the outside. So there a question was come in January 2021 suggested answer. Please student do refer this question. There we have set our limits, because there we have to see that our debt equity ratio should not be spoiled, and some ratios we have to meet criteria, then we are going proceeding further. Now next topic is coming, interface of financial policy and strategic management. Now student, it is very important, interface of financial policy and strategic management, because we have to, once we draft the policy, so our policy should be help us to make our strategic decision in a fruitful manner. Okay, because investment proposals normally requires, because once investment proposal, there are three type of investment proposal come into the before the management: for addition of a new product, increase in the level of operation, and cost reduction and efficient utilization of resources. So all are basically strategic decisions, because once we are clear about that, we are clear that okay, we have to go for a new product. Now question arises, what are the financial policy of the company in this matter? Maybe the financial policy of the company may be that, of course, if we are going for this product, new life of a new product line, whether we have a policy that how to arrange the funds, okay, how we will move further, and what should we have a debt equity ratio. So all these are parts of the financial policies. Now next topic is coming, the financial balancing financial goals vis-a-vis sustainable growth rate. Now, so far as balancing financial goals and vis-a-vis sustainable growth is concerned, now see student, it is very important. There are two type of growth. One is growth is good, but sometimes what happens, a high speed growth is not good, neither too slow nor too high growth. Because what happens, it is always said that if you are traveling by a car, or you are traveling by a bus. Now suppose if the driver of the bus or a car is driving very slow, so after some time you will start feeling irritated, and you will say, why you are driving so slow? Okay, of course, then he changed the speed, or he drives at a higher speed, then you will start feeling unsafe. Okay, then you will say, why are you driving so fast? So in both scenarios are not good, because both are extremes. So you somewhat find a moderate way in between. Okay, driving at a say average speed. Similarly, the growth should be like that, sustainable growth rate. Sustainable growth rate that can be maintained, because if the growth is very high, the expectation of the stakeholders will be very, very high. I give a very small example. Maybe you may laugh on the same, and it is very happen normally with us also in day-to-day life. Now suppose my son is studying in a class. Okay. Now if he is doing very excellent every time he is coming fifth in the first in the class. Now suppose any sometime if he does not attain the first position, and in a main exam, my expectation will be that he will again achieve the first position. But unfortunately, maybe due to any reason, he could not achieve the first position. Then ultimately, I will get disappointed. Okay, so similarly, when we are going on a very high growth, the stakeholders invest the money, they in the expectation of very high return. But if they don't get, they will not happy. Okay, so then it will be a problem for a corporate world. Similarly, if the growth is very slow, the stakeholders will start pumping out their money. Okay, this is a losing business. Okay, similarly, if any student is not teaching, is not interested in studying, the student, maybe the parents may say that okay, let us not invest in this education, because ultimately he's not going to the classes at all, he's not putting an effort. So ultimately, whatever you have to maintain, you have to maintain sustainable growth rate. So sustainable growth rate we can be defined. Before we go for the sustainable growth rate, there is one concept, internal growth rate. Now internal growth rate means the growth rate that can be maintained without the external assistance, and we can continue we can, because external, sorry, that we can maintain without external assistance, and that can be maintained with our internal funding. Internal funding means our retained earning. So I will just quickly discuss the formula. IGR is equal to return on asset into 1 minus D, that is dividend payout, or RO, return on asset, into plowback ratio. Okay, so this is simply the our return on this is the IGR, internal growth rate. Now I am coming to the next term, that is sustainable growth rate. Now here in sustainable growth rate, same thing is there, that we have here we are not going external funding, no external funding. Here we are going for external funding, but our leverage should not be affected. So we can say that what will be the growth rate if, of course, we are going for a debt, but our leverage should not be affected, our debt equity ratio should be maintained. Okay, so for this the formula is almost similar, only difference is that okay, so we can see here basically this is the formula. This is the differentiating factor. Okay, now when we talk about the ROE, if you recall that there was a one DuPont formula. Okay, and DuPont formula, the formula, if you recall it, is a very simple formula. ROE is basically profit after tax upon sales into sales, total assets into total assets upon equity. So ultimately total assets get crossed, sales get crossed. So ultimately profit after tax upon equity. Okay, student. So from this we can get the value. And student, please note that this portion is also called the equity multiplier. So student, I hope with this ultimately our topic, what is the first topic of the syllabus, financial policy, must be clear to you. Now I am coming to the second topic, important topic, risk management. One second. Student, the risk management topic has now becomes a very important topic nowadays, especially after the pandemic, because no one has thought about this scenario that everything will be locked down, because was a very unimaginable situation for us that we are sitting at a home for about 2 months, and all things were very, we are just coming out for essentials only. So it was a pandemic situation, and after this pandemic situation, the industry's attention has been more, industry has more, you can say, paid attention to this risk management aspect, because once we are on an online mode, with this increase in our usage of online mode, cyber security has also become an issue, and cyber risk has increased. So in this, mainly in our study SFM, we are concentrating, although there is a separate paper of the risk management where all these broad aspects or the framework are covered there, but here we are mainly concentrating on the financial risk, because ultimately the risk lead to the financial losses. So we have to see what are the various losses that can be faced by us. So first, identification of the type of the risk faced by an organization. Student, there are n number of risks. Okay, so we cannot say that this is a risk, another is this is not a risk. Risk are n number is only, it depends for one company, for one organization. One risk may be very important, other risk may not be that important. So, but broadly, we can say that some risk can be divided into the following categories. First is strategic risk. It is very important risk because it ultimately decides the fate of the fate of the company. Because your strategic means it ultimately, it is change the scenario of your whole business, change the, you can say, all nitty-gritties of your business, and this can be due to some technological changes. Okay, the company may be using some technology tomorrow, and new technology can come and it can spoil it. I remember that there was some when we were in our college days, there were used to be video cassettes. Okay, so we used to take the cassettes on a rent and we used to play the movies, etc. Now it has switched over from the video to the CDs mode. Okay, then in CDs it was, then it comes to the DVDs. Okay, now then it comes to the online streaming. Now today's time is online streaming. If we talk any about this, I have a CD of this movie, that's useless. Everything is available on the net. Not available on the net. Okay, you go for the online streaming. So with this, the existing business may be affected, and entry of the new competitor, it is very important. Any new competitor, because it is always a very fact that where there is a growth, where there is a profit, there will 100 competitor will be there. Next is entering, shifting the customer, shift in customer demand. Customer taste may have changed. Okay, it is very important. The customer change may. So all these are factors. Increase in raw material cost. So there are n number of factors that affect our strategic decisions, and these are called strategic risk. Next is compliance risk. Student, it is very important, especially in today's world. The compliances have increased a number fold. Vivek sir is looking after the paper of, I think, capital financial services and capital market. This is paper number 6V. So Vivek, I think there are how many compliances maybe there in your capital market if you talk about SEBI? Numerous compliances, because sometime we discuss it here in the office. He says, sir, there are n number, because he's SEBI LOD are there.
LOD is there and ICDR is there.
ICD are there, and there are n numbers of there, n numbers of compliances are there. So you have to see that no compliances are missing. This is only capital market. There are tax compliances, like if the company is in a foreign exchange, they have a FAMA compliances. Okay, if we can say, okay, company is not earning the profit, company is any firm or an organization is in charity business. Because my earlier experience was with my in a research organization, they were not a profit making organization, but I remember that around it was, I'm just talking about the 15 years back, our compliance is even more than any corporate firm, because we have to take care of FCRA, Foreign Contribution Regulation Act, FAMA. Okay, then for exemption, we have to file the papers with the income tax department. Even if we are, say, we are receiving any payment from our, because we have a part of building we have let out. So because the tenant does not deduct the TDS, I have to take the exemption from the income tax department. So all these compliances are there, and if we fail to meet any compliances, of course, it may lead to the fine and even imprisonment in some cases. And one very important, I forgot, ESI compliances, employee related compliances. If the company is not depositing the provident fund properly, then they may also be in a problem. So all these are compliance. Now next comes the operational risk. Student, operational risk is very important. I give you because it is relating to the pupil and a process. Process means the process are there. If any process is a loose end, there is a pilferage in the process. Of course, there will be a cash pilferage. There will be frauds. Okay, so these are relating to the process. Now, pupil means sometime, of course, there may be some flaw in the process that comes to the knowledge of the company later on. Okay, we have this flaw, but even this can be in a computer system. Now, if any bugs or a virus comes into the computer system and it hacks all the organization's computers, of course, this is due to the process. But sometimes there may be some malified intention of any person that is relating to the pupil. Okay, they may have taken a position that is beyond the capacity of the company also. And very good example I always quote, that was a Barings Banks case. Student, this was a case of 1995, and a Nick Leeson person. Even if you can get it on the internet, just type it Barings Banks case. It is a very famous case, and this I will also advise the student to refer this case also, because this is somewhat relating to the derivatives. Because Nick Leeson, the floor manager, has taken a very huge position in Nifty, in not Nifty, it was, I think, he has taken the SGF, Singapore Stock Exchange, he has taken the position in the index future. Basically, in the index future, he has taken a very wide position. And since there was some earthquake in the Kyoto, the index hasn't gone down, and ultimately it had led to the loss of the this bank has become the bankrupt. And why it was bankrupt? Because he has manipulated the data. He has manipulated the figure. It is not that this loss was in a single day. The loss was incurring the day by day. It was increasing. It was ballooning. Okay, it was ballooning very at a high rate. But what he was doing, he was hiding it. Okay, because he was ultimately in charge of the back office as well as the front office. So that's why in Treasury Department there are three offices. One is back, mid, and back. Front office do the dealing. Okay, mid office normally execute the dealings, and back office normally carry out. Sorry, no, they carry out the accounting part. Since this Nick Leeson was in charge of every part of the office, he had hidden these losses. So this is a very good case on the operational risk. Next is coming financial risk. Now, when we talk about the financial risk, this one is risk is counterparty risk. Counterparty risk means the other party is not honoring their obligation. For example, in a company, a person has purchased the goods from the company on the credit, because normally the selling the goods on a credit is a normal part of a business. Because if you want to remain in the business, you have to sell the goods on the credit. Okay, of course, this may not be that much in the retail business, but in the wholesale business, this is a regular feature. Now, if the other party is not making the payment, it is a counterparty risk. Similarly, in case of a bank, when one person has taken the loan and they are not repaying the interest and the principal also, okay, defaulting by the borrower, this is a counterparty risk. Next is political risk. Student, although the political risk is not directly, we can say, financial risk, but political risk ultimately directly lead to the financial risk. Why? And political risk is mainly important in context of the international financial management, because in international financial management we invest the money outside India, outside the country of because outside the country of the company. Now their government may turn hostile, so in that case the all the investment will be gone into the waste. So it is very important that ultimately, because the government normally say confiscation of the assets, restriction on the exchange, repatriation. So there can be many problems can be there. Next is interest rate risk. Now, student, in this there is a topic of interest rate risk management, and interest rate risk means when the, because there are two type of, because interest never remains static, it keeps on the changing. Okay, it depends on the market expectation. There are n number of economic factors. So when, suppose you are holding one asset, I'll just give you a very small example. Why this you can realize. Now today, say the rate of interest in market is 6%. I buy a fixed FD. I make the investment of say 1 lakh in a FD, in the expectation that every year I will get the 6,000 rupees. Now say after 1 year, the rate of interest comes 8%. So at that time, if I had made the FD, of course I will get 8,000. So now what is the risk to me? I am investing the same amount, but I am getting the lesser interest. So that's why we shall discuss more when we shall take up the topic of interest rate, but this is called interest rate risk. Next is currency exchange risk. There is again a topic, foreign exchange risk exposure and risk management. Now, foreign exchange exposure means, because especially these risks are faced by the companies which are in the foreign business. They are normally dealing with the foreign countries, like they can be importer or they can be exporter. So when they do business with the outside the firms of the country, they are facing this risk. And my mistake, interest rate risks are more important in case of banking business, that we will discuss in. And last is the liquidity risk. Not last, there can be another risk, but in our list, liquidity risk is very important, students. And this is you are relating to your working capital management, because cash is basically a non income generating asset. I just give you a very small example. Suppose today the one you have say 10,000 of rupees with you, and you just put in the drawer and lock it, or you just put in an almirah, lock it. Now after 2 years, if you open the drawer or the almirah and bring out the money will remain 10,000. It will not increase. Of course, if you have made a, instead of that, you have made the deposit at the rate of 6%, okay, per annum. So of course, when you bring out this money from the bank, okay, the amount may be to some 11,000 or 200 something rupees. So cash is a non-generative, but you have to keep the cash with you for your meeting your contingencies. So there you have to strike a balance, this is called trade-off. This is called trade-off between liquidity and profitability. You can say that. So liquidity management is an important part, and that's why sometimes it banks maybe fail. If you have heard the term bank rush, what is bank rush? You know that, Vivek, bank rush, when everyone person reach to the bank. Because frankly speaking, student, you must have studied in your macroeconomics paper that no banks does not hold the whole cash in their chest. This is called your cash reserve ratio, and normally this is somewhere hovering around 10 to 5%. Now suppose if 100% depositor reach there to get their cash back, ultimately bank will fail. So liquidity management is also very important. That's why in business we have to see. Now when we come out to the that's evaluation of financial risk, that you can refer from the study material, because we have to paucity of the time. I have to just cut down my discussion here small. Now I am coming to most important, value at a risk. Now student, it is a very important term, and these are financial used very frequently in our financial world. Value at risk means that what is the worst case scenario? Okay, what will be the maximum? Like say that if I am going to take an exam, so at the most, what will be the worst? Of course, like in CA examination, what we say, what is the most worst thing? Of course, I will fail. No problem. I will again sit after 6 months. Okay, of course, we never should try to fail in the examination. We should put our 100% efforts there, but still, it's due to some reasons we could not go through. So this is the worst scenario. Similarly, in financial business, we can see that okay, what is the worst situation? What will be our maximum loss? Okay, so there are components of the calculations of the where, and in this the three important components are there. Time period, because whenever we talk about any our maximum possible loss, they have to put in some time frame. That cannot be because we cannot say that this is a blanket statement, but we have to define the time frame, that it can be one day, it can be week, or it can be a month, or it can be a year. So we can decide some time frame, that during this time frame our maximum loss will be this much. Next is confidence level. How much confidence level we want, that 95% sure that maximum to maximum loss will this much, or it can be 99%. Now loss in the percentage or in the amount, this can be both ways. Because in a portfolio, when we are holding any particular type of portfolio and we say the maximum loss will be say 1%. So if the amount of portfolio is 1 lakh, of course our maximum loss can be amount of 1000. So you can refer the application from there. Now last is the evaluation of the appropriate method of identification and management of risk. Now student, there are some applications are there of how you have to evaluate these risks, political risk, all these risks you have to evaluate. So for example, now if I talk about your counterparty risk, you should obtain their due diligence, you should carry out. Political risk, you should refer the your political references, journals, and even better it is you employ the labor there. Even you take the fund from this host country, because ultimately their stake will be involved. Now for interest rate risk, you can refer the government policy, like very important. Now monetary policy of the government is very important. Now recently, or in the coming day, you must have heard, the federal has decided to increase their interest rate, and as a result the market is in a bad shape. Okay, everyday market is shaking because of their decision. So it is one of the very important, because what is happening, why the money is pumping out from here, why the market is shaking, because with the increase in the interest in the US, the investors are bringing out their money and investing in a USA. Dollar investment is there, that's the reason. Similarly, there can economic growth data, CPI, inflation data, all these, because if you have referred the term nominal interest rate, what is the formula? If I just recall it, 2 minutes, I am just taking you. 1 plus inflation into 1 plus real rate equal to 1 plus nominal rate. Okay, student. So if my inflation is increasing, of course, my interest rate is also there. As the inflation increases, interest rate has also becomes very high. Okay, student. So I hope this must be clear to you. Now I am coming to the next. This is currency risk, government action, nominal interest rate also depend because normal. I mean, now I am saying nominal interest rate. Now here the topic of interest rate parity come into the picture. Okay, purchasing power parity. So all these factors affect your currency risk. Okay, so and most important, your natural calamities, war, coup, revelation, all these topics are there that has been covered in your currency risk. So you just give a reading, and student, please understand. And very important, student, the in a theoretical question, sometimes students say that, of course, I will read this topic. Just it is enough. Student, recently I am just sharing with you experience. One student has approached to our board of studies, and he said कि sir मेरे marks my marks are not that much. So I said, where do you have lost your marks? Sir कहता है in theory. So मैंने कहा why? कहता है because sir I have referred some notes. मैंने कहा from which notes? One second student. He said referred some coaching center's name. He said, you sir, there are notes they have given me and I have done through. So I said, okay, but student, please refer the study material. Meanwhile, I just said, okay, just wait. He said, sir, it is also available on the internet. When I saw the notes, what was it? It was ultimately the copied from the study material. What one single line has been written there? Just write 1 or 2 lines with your own understanding. Student, please note, this is not the right thing. Don't, if you should be very clear about the theoretical. Of course, tomorrow I will more throw the light on the how do you write the theory in your examination. But I am making you very making warning, giving you a warning. You can say I am just advising you. Please don't go by this punji type of things. Okay, because ultimately you should refer the properly study material for the theory, underline your points, and it will be better if you make your own notes. Why are you taking these short notes from the internet or website, etc.? Make your own notes and develop your understanding. So with this, I am coming to this topic. The first two topic I have covered. Now, technical security analysis, CS Vivek Banerjee will discuss this topic. What is this, all this nitty-gritty is about on the same. Vivek, now hand over to you.
Thank you, sir. Security analysis means
Vivek, just 2 minutes. Before I proceed further, I think there are 2 queries are there. I saw that I just 1 second, just refresh it. Okay, students, there are 2 queries are there. One is there, is the institute study material enough to clear the exam? Student, please note, yes, it is enough. Okay, but in addition to that, please also refer the suggested answers, okay, of the previous at least 6 examination, RTP, mock tests. Now here the mock test is coming. Tomorrow I will more throw in the light how you attempt the mock test. So as our Director Board of Studies has advised you to attempt the mock test, because mock test is the pillar of your success. Okay, so please never skip the mock test in whatever way you attempt the same. Okay, and one more important, students, please don't cram the question in SFM. It matters. You should understand what has been asked in the exam, what is the requirement of the question, and how we have reached to the solution. It is very important. Okay. Now the student is saying, sir, is some question institute answer incorrect? Do we have to learn the way ICI solved or student? In this matter, my reservation is there. Now, student, if you feel that there is an error in the ICI material, so don't just keep this doubt in your mind. You please send this email to me immediately, because I am more interested in clarifying this type of doubt, because earlier 1 or 2 days back one student had said, sir, there is an error. Okay, when I make him understand the point over the telephone, then he says, "Sir, sorry." That's why I say sometimes you may have misunderstood term as a error, but exactly it may not be error. So my request to you, please, student, in this matter, please send the email immediately, or even you contact me over the telephone. I will share with my number with you. Okay, Vivek, sorry to interrupt. Now it is over to you. Thank you.
Thank you, sir. Security analysis means analysis of the securities of a company. There are two aspects to it, fundamental analysis and technical analysis. I will give you a brief example in which it will be clear to you and you will be appreciate the difference between these two terms, that fundamental analysis and technical analysis. Let us suppose you go for a vacation, and after some sightseeing in the afternoon, you got hungry and you want to eat something. You go to the central market, there are about 8-10 restaurants, and you are basically confused about which restaurant to pick. So, what you did was you asked some people, and on the basis of their feedback, you choose 2-3 restaurant. You get there, have some sample foods, and select a particular restaurant, enjoy your meal, and go out. Your friend has a altogether different strategy. What he did was he did nothing. He sit beside in front of a bench and he observes. He observes that out of the 8 to 10 restaurants, one particular restaurant has the highest number of you can say people coming into it. People are coming into it, and if when you peeked inside the window, your friend, he saw that almost all the seats are occupied at all times, means for 15, 20 minutes, 25 minutes, in which he has observed. So he visited that restaurant again, enjoy his meal, and come out. So the first one, you are a fundamental analyst and your friend is a technical analyst. So what is the difference? The fundamental analyst basically goes deep into it, analyzing the aspects, and it is basically for a long term. And technical analyst basically depend on the psychology of the people or behavior of the people, and it is generally short term in nature, and it believes in the trend, because your friend simply sit on the bench and observes. After observing for some time, he came to a conclusion: yes, there is the highest number of people arriving at such a restaurant, so he went there, enjoyed his meal, and go out of the this restaurant. So, I will take a few minutes to further elaborate it, fundamental analysis and technical analysis. Fundamental analysis, as I said, enables an analyst to delve deep into the company about the fundamentals. What are the fundamentals? Economy, industry, and company. So it is also called EIC analysis, economic, industry, and company. I will give you a simple example. For example, the GDP growth rate is, for example, it is hovering around about 7%. And it is projected to increase from 7% to 8% within a next quarter. So, as a fundamental analyst, you think that yes, the GDP growth rate is likely to increase, so the economy will be good. So, the companies will most probably have a good profitability. So, the Sensex or the stock market or a Nifty will move up. So, in such situation, as an investor, the decision may be to stay invest in the stocks of a particular company. Another aspect is inflation. It is also very important. Some amount of inflation, students, is actually beneficial for a company, because if the prices of some of the commodities or some of the materials things go up, then it will increase the sales and profitability of a particular company. But too much inflation is actually harm a particular organization. The reason is that if the inflation is very high, then the people will hesitant to purchase. They will curtail down their expenses. So that will ultimately affect the supply of the company. By this, the sales will reduce, the profitability will reduce, and this will ultimately reflect on their share prices also. So, if the inflation is too high, as in the current situation, the inflation is very high. It is now moderate a bit, but in such high inflation cases, as a fundamental analyst, the investor may think, yes, that it is. Let us wait for some time. Let the inflation cool down for some days, and then we can invest. So this is another aspect of fundamental analysis is industry analysis. For example, let us suppose the housing sector is in boom. So which industries it will benefit? Obviously, the real estate sector will benefit by this, and the adjacent or the sector ancillary to it, that is the cement sector and the steel sector. Because if there is a housing boom, there will be more construction, and then steel or cement will be required. So cement and steel sector will get a boost. So as a fundamental analyst, you think that if there is a housing boom, then there will be an opportunity to invest in the cement and the steel stocks. So, economic analysis, industry analysis, then as a fundamental analyst, you curtail down to the company analysis, which is very, very important. There are two aspects in company analysis: financial aspect and the management aspect. In financial analysis, while doing a company analysis, you analyze that whether the company have a good profitability record, sales record for the last 5 to 10 years. The company has a good cash flow position for the last 5 to 10 years. The company is reducing its debt. So these are the main aspects you see while doing a financial analysis of a company. Then you come to the management, which is equally important as the financial analysis. You see who are at the helm of the affairs of the company, who are the CEO, CFO of the company, and how do they address the concerns of the investors. So if the management is holding a sufficient number of conference calls and addressing to the queries of the investor, you can say that yes, the management is good, it is performing well. So these are the basically the aspect of fundamental analysis: economic analysis, industry, and the company. Now come to the technical analysis. Technical analysis, as I have given the example that it depends on the psychology or behavior of the people. That is, it relies upon the trends. So, in technical analysts believe that the prices move in trends. And another important aspect of technical analysis is the history tends to repeat itself. Because something have happened in the past, if some circumstances are still happening, it is chances are that it will happen in the future also. And last but not the least, another important aspect is the market discounts everything. That is, the market considers and adjusts the every information which is available. For example, the budget is not very good, or the budget is bad in the perception of the people. So that will reflect in the prices of the most of the stocks. So, in these are the you can say the very important aspect of the technical analysis. Now, in this security analysis chapter, there is another important aspect which is called the efficient market hypothesis. As per the efficient market hypothesis, the price actually reflects everything, every information, and it is not possible to predict the prices of a particular stock. There are three forms of market efficiency: weak form of efficiency, semi-strong form of efficiency, and strong form of efficiency. Weak form of efficiency means that the current prices reflect all the past information. I will give a simple example that in case of a particular company, ABC, it is showing a consistent profitability record for the last 5 years. So on the basis of the consistent profitability for the last 5 years, you decide to invest in the stock of that particular company. But after investing in it, next week you saw that the stock prices are coming down. So why this is so? This is so because the market has already adjusted the previous, you can say, the financial information, the profitability. So it has already reflected, already adjusted this information. So this is weak form of efficiency, means current prices adjust the all the means in the market prices all the past information are already reflected. It considers all the past information, already have considered all the past information. Now, the next is semi-strong form of efficiency. Semi-strong form of efficiency means the market reflects not only the considers, I would say, not only the past information, but also the publicly available information. Let us consider another simple example. In case of a particular company, the news broke out that one of its warehouses caught fire and almost all the goods have been damaged. You read the information after 3 days and decided to, but unfortunately you're holding the shares of that particular company. So immediately you sold all the information because you think that yes, this negative news came, the prices will come down. But on your surprise, you surprise the next day that the prices have actually gone up. So why this is so? This is so because the market have already considered this information that there is fire in the warehouse. The negative news have already reflected in the prices. So this is semi-strong form of efficiency. And the last one is strong form of efficiency. Strong form of efficiency means the market price not only reflects the public information, it also reflects the private information also. Private information, you can mean the insider information. There are certain insiders in the company, as you know, the CEO of the company, the CFO of the companies. They know the day-to-day aspect of the company and also know the strategies of a company, that what the company is planning to do. For example, a particular company, you can say XYZ Limited, is planning a major mergers and acquisition. And this information is not publicly available. This information, certain people know about this information, the CEO, CFO, and the chief executive, chief operating officer. And certain number of people knows about this information. And they decide to, on the basis of such information, they decide to invest in the stocks of that particular company. So such information will also be reflected in the prices because once they have invested in the stock prices, the price chart in front of the technical analysis will consider such informations also. So this strong form of efficiency tells us that the market reflects not only the public information but also the private information, the insider information also. But now the SEBI has been very strong in curtailing the insider trading, and insider trading have come down because of this efforts by the SEBI. So this is what about security analysis. I will come to the next topic, which is I will come to the
One second.
next topic, which is security valuation. After doing this fundamental analysis, that is analysis of the company, analysis of the economy, industry, and the company, the next step is to value the particular company. And this is what is about valuation. And after valuing this company, you as an investor take a decision that whether to purchase the particular stock of a company or not. There are certain return concepts in security valuation, that is required rate of return, discount rate, and internal rate of return. Required rate of return is the minimum rate of return which as an investor hopes to receive while investing in the shares of a particular company. And discount rate, as you know, is the rate at which the you can say the future cash flows are discounted to arrive at the present value. And internal rate of return is the rate at which equates the present value of the future cash flows to its current market price. Now come to the next topic, which is equity risk premium. Students, when a particular investor wants to invest in the equity shares of a company, he knows that the equity shares are risky. So he wants a premium on it. He wants some extra return on it. That is what is called equity risk premium. For example, if an investor wants to invest in government security, he will get 8%. But while investing in the equity shares, he will get 12%. So the 4% extra which he is willing to get is actually equity risk premium. Because in equity shares, he is taking higher risk. That is why he wants a higher premium or higher return on it. This is you can say the simple concept of the equity risk premium. Now come to the required rate of return. Required return on equity, I have also told. This is basically cost of equity, and it is actually you can say utilized to calculate the value. That is the present value of the future cash flows. So this is the discount rate which is used to calculate the present value of future cash flows. There are certain discount rate selection in relation to cash flows. There are two types of cash flows, nominal cash flows and the real cash flows. So nominal cash flows are those cash flows without, means without adjusting any inflation. In real cash flows, the inflation is adjusted. So in nominal cash flow, you apply nominal rate of discount, and in real cash flow, you apply real rate of discount. But what about valuation of equity shares? While valuing equity shares, nominal rate of discount is actually used. There is a basic reason about it. The reason is that the tax aspect, that is the tax applying to corporate earnings, is generally stated in the nominal terms. Now, approaches to valuation of equity shares. This is very important aspect, students. There are three methods to it: dividend-based valuation, earning-based valuation, and cash flow-based valuation. So in dividend-based valuation, basically the Gordon's method is followed, and in this case, the present value of equity shares are basically calculated. So first of all, a dividend is estimated, that what are the future dividend. On the basis of present dividend, future dividends are estimated, and then those future dividends are discounted by a discount rate, which is actually a cost of equity, to arrive at the present value of the equity shares, which is also called the intrinsic value. So on the basis of intrinsic value, we decide about the whether to invest in the stock of a company or not, which I will arrive at discuss it a little later. The next aspect is earning based module. This is simply an extension of the dividend based, because if a company is not declaring dividend, it is plowing back the entire profits or majority of the profits, then the future earnings are estimated. Discount rate is applied to calculate the present value of the equity shares. The last aspect which is applied in while valuing equity shares is the cash flow based model. The cash flow based model is actually used in the most of the situation. It is the most practical and used in most number of cases while valuing the equity shares. So how to go about it? First of all, the cash flows are, you can say, projected on the basis of the present cash flows. And then you can say, the first of all, you can say from the net profit, non-cash expenses are added to arrive at the cash flow, and then from that, the capital expenditure and the, you can say, the net working capital is adjusted to arrive at the free cash flow, and then discount rate is used to arrive at the present value of the equity shares.
You need pen?
Yes, sir.
Yes. You need, no, you just continue.
Yes.
One
Thank you. So out of this, in this free cash flow method, from net profit, non-cash expenses are added. Okay.
Vivek, just we have received two queries.
Okay.
Will you take up it now or just later on?
After this, I will take
Okay.
the free cash flow. I will take it.
Okay.
So this non-cash expenses are added. Then whatever amount that is arrived at from that, the capital expenditure are deducted, and then any change in net working capital is also deducted to arrive at free cash flow. To arrive at the free cash flow.
No problem.
Okay, I am
just click it. No, here. 1 second.
So after arriving at the free cash flow, you discount it at the cost of equity, which is the discount rate, to arrive at the value of equity shares. So this is what about the valuation equity shares on the basis of the free cash flow method. Okay, now this valuation of preference shares, while valuing preference shares is more or less, you can say similar to valuation of equity shares. There are two aspects, that is when the preference shares are redeemable and when the preference shares are not redeemable. When the preference shares are redeemable, this is the way to calculate it is very simple. One second. The way to calculate it very simple. When the preference shares are redeemable, so the value is calculated on the basis of, you can say, dividend of first year, and you will discount it at a rate of discount. Okay, and then the whatever dividend you received in the second year, you discount it by the discount rate, and this carries on. And for example, the preference shares are issued for 5 years. Then after the end of the 5 years, you apply the discount rate for the 5 years, and from this dividend further you will add the maturity value also. You will add the maturity value also, because after the end of the 5 years, whatever amount you have invested in preference shares will be returned back to you. So every year's dividend will be discounted to arrive at the present value, and also the maturity value, the amount, the lump sum amount which you have invested in the redeemable preference shares will be returned to you, redeemed to you after the 5 years, and that the present value of that amount also has to be calculated. So this is in the case of the redeemable preference shares. And in the case of irredeemable, if the preference shares you have been invested is irredeemable, then the simple formula is it will be dividend will be same, because it will be perpetual, and you apply the discount rate, which is the required rate of return on the preference share. The formula is very simple. So now, in case of valuation of debentures bond, I will hand it over to Ashish sir.
Thanks a lot, Vivek. Now, student, just before I proceed further, here I would like to discuss one thing with you. Student, the security valuation topic is basically the reverse side of the one of the topic that you have studied at your intermediate level, that is called cost of sources of finance, or I think it was somewhere cost of capital, if you remember this topic. Now here what was happening, sorry, one second student, here in this topic, my 1 second student, I just get it. Okay, I think it is visible, or otherwise I should increase it. No problem. Now here in this topic, student, when we talk about the cost of capital, there are three sources. One is equity, one is preference share, another is debenture or bonds. Okay, true. Now here what happens, student, when we talk about our equity, the formula was we need to calculate, that is KE. Okay, KE is equal to, if you recall it, D1 upon my P plus G. Okay, now here this value was unknown. Okay, but now when we come into the final, here what we have, this value is available with us, this value is available with us, this value is available with us. Now the unknown value is this one. So accordingly we just interchange and we get the value is T1 upon may Ke minus G. Okay, this value is with us, with this value is with us, this value is with us. With these three values we compute this value. So clear? Now whatever you have studied at your intermediate level, now it is the reverse side of the same. Similarly, in a preference share, the formula was D upon P, especially in case of a irredeemable, is equal to Kp. Okay, now here this Kp value must be given to us, but here how much this value has been given, but how much dividend price justified is calculatable. So I hope one second, I just okay. So here ultimately what we are going on the reverse side. Okay, before I proceed for the bond, just we have received some queries. Let us go by the queries. So Vivek, there is one query for you. Which form of market efficiency, which form of efficient market is generally?
Students, that is a pertinent question, that which part of efficient market is generally. You can say that the market cannot be predicted. The basic concept of efficient market hypothesis is that the market cannot be predicted. Therefore, there are three parts: the weak form of efficiency, semi-strong, and the strong form of efficiency. But in practicality, we can say that to a large extent, the strong form of efficiency applies, because the market, as I have explained with the help of a simple example, that market not only considers the past information, that is, if good profitability record in the past, or the publicly available information, that is, there is a news broke out that there is a fire in the warehouse of a particular company, or any private inside information which the insiders of the company are in the knowledge, that is, any future mergers and acquisition proposal which is not available to the public in general. So, and they trade on the base, and the insiders trade on the basis of such insider information, private information. All this information is reflected in the charts or the prices of the company. So, therefore, we can say that to a large extent, the strong form of efficiency applies. And the truth is that yes, the market cannot be predicted as per the efficient market hypothesis.
Okay, thank you, Vivek. Now I am coming to the next query. This is a query, I will reply it. The student is asking, sir, techniques of technical analysis is important for examination. Yes, student. See, technical analysis is a very wide topic. Okay, you can refer if you go to the website, there are n number of study material is there. But my advice to you, just restrict to yourself what has been covered in the study material, because in study material there are some EMA and some concept has been there. So just restrict to yourself to, because technical analysis is a very wide term. So please, but do that. Don't skip this, because all topics are covered in the study material are very important. Okay. Now one student has asked, will be given values of epsilon and natural log in a paper, or we need to remember them? Student, please remember that these values cannot be memorized. Okay, because you don't know the question which values will be used in the examination. So of course this value will be provided along with the question itself. In case it has not been provided, so don't worry, you ask for the in examination, you ask for the table. Even if they don't provide you, don't worry, just leave the question there. Okay, we will take care of the same, because it is not in your hand, so we will take care of the same. So but because normally we instruct the examiner, that paper setters, that these values should be provided in the question paper itself. So don't worry about the same on this aspect, and don't waste your time in memorizing this value. Of course there is some formula on a calculator that is calculating the exponential values, but my advice to you, please don't do that, because it will time consuming. So my request to you, just If the value has been provided, so you go ahead, otherwise no. Especially in case of an option derivative that I will discuss, where normally the exponential value is used for the daily compounding. Now, if daily compounding value is not available with you, but if the value has been given, of course you are supposed to use the value, then you cannot skip it. But if the value has not been given in the question, then you can do it with the simple compounding. You will be awarded marks. So don't worry on that part. Okay, so now you know to cram these values. Now I am coming to the topic of the bond valuation. Student, although it is a very single line in the syllabus, it is a single line, but what happens when we talk about the same? One second. When we talk about this topic, it is a very important or as well as a quite topic has been covered in detail. Now, when we talk about the bonds, there are two type of bonds are generally covered. One is coupon bond, another is zero coupon bond. Okay. Now, in this coupon bond, the four features are normally face value, or we can say par value. This is the coupon rate. Okay, frequency of payment. This can be coupon your yearly or semi-annually. Normally, there are two categories of coupon are there. There can not be that coupon that which are monthly, etc. Okay, of course, if in the question it has been given, then you have to go by the same. Otherwise, normally, usually the two types of coupons are there. Then there is a maturity period. Then last is redemption on maturity. We can say it is kind of a bullet repayment. Of course, there can be another option that is some part of it may be repaying during this period, during this scenario period during the tenancy of the tenure of the bond. But normally, most of the questions are involved basically bullet repayment. Now, there is another zero coupon bond. If we talk about a zero coupon bond, there is no such par value, because what is par value is basically the redemption value. Okay, here basically your discounted value. They are issued at a discounted price. Okay, and maturity period, of course, there is there. And difference between this discounted value and redemption value is basically your this interest, that is your coupon. Okay, students. So these are the basically two type of bond. Now I am coming to the if you recall that how we compute the bond valuation model, because this is basically your debenture valuation model. Now I am here just if you recall that, then you will say, sir, we have already solved this formula. Or we can say it is a fixed. Here we can write it like that. Okay, students. Now let us see. Or we can say that I into present value annuity factor at the rate of KD for the period of N plus M into present value and present value investment factor. Here annuity will not come, KD into N. Now student, please recall it as I told you, this value you need to find in your intermediate examination by doing the method of, if you recall that the IRR, we used to call it IRR, internal rate of return, and you used to use the interpolation formula. You used to discount the values by one discount rate, then another discount rate, then compute use the differences to by using the interpolation method you get this value. Now here this value is with you. Now question is, what is this value? This value is basically the YTM. Now question arises, what is this YTM? Now student, this YTM is basically can be defined as a discounting rate KD at which the present value of future cash flow from a bond equals to its market value. Okay, it is the rate at which you can say it is a market rate. It is a market rate because in market, if the, and this is also called the yield. Simple yield, we can also say that. Okay, so now here it is very important that, one second. Okay, student. So it is very important that this is a yield, and because ultimately this yield in the market decides the value. Okay, so on this basis, there are some theorem, or we can say the value of the bond. If the YTM is equal to coupon rate, the bond must be selling at par. Okay, if YTM means, we can say YTM is also the kind of expectation of an investor from the market. Okay, if the YTM is greater than coupon rate, the bond must be selling at discount. As I told you, if at a 10,000 invest, I have invested the money, I am getting 6%. After 1 year, the rate of interest comes 8%. Of course, now to get the 6,000 rupees, I did not need to invest 10,000. How much I need the money? If I get this figure, 1 second. Sorry, my mistake. It is 600. Okay, so I need to invest 7,500 to get this amount of 600. Okay, just getting the 600 rupees for the same, because now the interest rate has been increased, that is yield. I need to invest only 7,500. So ultimately there is a fall of rupees 2,500 in this value of FD. This is the value of bond. Okay, student, I think you must, it must have been clear to you. Now we are coming to, if the YTM is less than your coupon rate, so it is selling at premium. Continuing by the same example, now suppose the rate of interest has come down. Suppose the rate of interest has come down. They have say come down to the 5%. Now if to get the 600 again rupees, how much I need to invest? I need to invest 12,000. So now it is a 2,000 is a premium. Okay, because this bond is ultimately giving, although the bond or the investment is 10,000, but it is yielding the higher rate of interest. That's why it is selling at a premium. So I hope this is very common concept. It must be clear to you. Okay, now when we called the there is a one student, because when we talk about the bond, there are some relationship that we need to understand. Okay, there are some price yield relationship. Okay, student, it says that there is a reverse relationship. Okay, if the yield is increasing, the value or the price of bond is downfall because expectations are increasing. So here it is called inverse relationship. This is called inverse relationship. Now, next important aspect I am discussing with you is the duration of the bond. Now, student, please note, this is what is duration of the bond. Basically, duration, or sometimes student get confused duration and the maturity period. See, student, both are different concept. Basically, duration, you can say it can be defined as the average weighted time within which the investor gets its money back. Okay, so this is called duration of the bond. And please remember that if we talk about the duration of the bond, here we have to note that in a case of a coupon bond, the duration will always be less than its maturity period. It can never be more than it. Okay, in case of a zero coupon bond means I need not to just amplify the same, just where the discount, it has been issued at a discount and it is redeemable at a face value. Now here in this case, the duration and the maturity period will be same. It is very important to note. Okay, student. So here, what is duration means we have to now from this duration. Why we use this duration concept here? Because from duration we can find the volatility shall be discussed in the volatility means standard deviation. Okay, when we talk about a standard deviation, of course, portfolio management comes into our mind. Portfolio management, in when we talk about the volatility in context of a portfolio management, normally we cover the equity shares there. Okay, but when we talk about the volatility of the bond, because it is just also moving, like as we have seen here in our this top when the prices of the this bond is also related to the interest rate. So there is also the risk factor is there. Volatility means risk, and when risk factor is there, then how we compute the risk of the bond, that we comes get the value through the duration concept. Now let us see the formula, because it is a very important formula. Now student, the formula is, because for is a modified duration to compute the volatility. Okay, the formula is Macaulay duration. This is also called Macaulay duration. In years divided by, this formula has been given to you in your study material. Please refer the. Okay, this will give us the volatility of any particular bond. Now, student, when we talk about this concept of bond, here I would like to highlight one thing. Basically, when we computation of the duration, basically there are two approaches. Both approaches have been discussed in the study material. Well, there is one formula. Okay, there is one formula approach is there. If you can cram it, it is cram it, but it is quite difficult to cram it. There is another approach is tabular approach. Okay, so in this there can be further two version of the same. Okay, here we can use the proportionate method, or another is multiplication method. Okay, I just quote you a very small example. Now please refer page number 4.56 from your study material. I'm not solving proper question there. You just refer the, Vivek, just give me the study material. I'm just give the refer. Student, please refer page number 4.56. And the question number is 26. Okay, so there is one table just on the top. The duration calculation is there. Okay, student. Now I am just presenting you the different version. This version is there already. I am just giving you this version is basically based on the proportionate. Okay, now I am just giving you another version that is based on the multiplication. Okay, now student, please remember this may not be available in any book because this is my own creation. This method not method, but this is classification is my own creation. Now here just I am solving you for you. You just note it down also. This will helpful you for your examination. Okay, now cash flows are there. Okay, now PV factor is there. Okay, PV present value, just I am multiplying the same. 136. Okay, no problem. I values are there with me. Just Vivek, just check it. If I am going any wrong on any side, just let me know. Okay.
It's 119.96.
Wait. No. No, here it is 1. Sorry. Oh, yeah. You are right. 1 second, student. Sorry, my mistake. You are Vivek. That's why I was doubtful little bit. Just I am giving it. I am just multiplying it. Yes, you are right. 116. I have seen the. Let me put on the specs. Yes, 99.84, 85.44, 72.96, and 452.40. The total comes 964.40. Now, student, what I do, I multiply this. Okay, both figure I multiply here. So my figure comes 136.8. This one, you will not get this value there. Or you can do one thing, you just check it on the calculator. This is 2 into this, and similarly 3 into this. Okay. Okay, just check it quickly. If any mistake, student, you can also check. Okay. So student, now duration can be simply find out, and this formula, this approach is quite simple. The value comes 4.242 is nearby the value given in the 4.247. It is somewhere nearby. Okay, na? So students, I hope you must have understood with this formula can also be used. Okay, now I am coming to the another aspect, that is convexity adjustment. Now student, when we are using this bond valuation, so normally we say, when I have drawn the curve, because we say if there is when we talk about the duration, and from the duration when we compute the volatility, we normally say that, because ultimately modified duration let us know that if there is a fall of say 1% in interest rate, then how much will be increase in the bond value, and this depend on the modified duration. So normally we draw out one chart. Okay, we normally we draw out one chart. Okay, that if this is a change in value, then this will be the change in the value of the bond on the based on this duration. But what happens? It has been seen that actually this may not be the possible. This may not be the exactly happen. There may be some change. Now I just show you. Now suppose if I draw the, because if I go by the same, as per this version, we can say this will be our yield curve like that. Okay, this will be our yield curve, or we can say here our the value of bond, here our yield or YTM. But practically what happens, this shape comes into the curve. Okay, so what happens, this area is called convexity effect. This difference is called this is called convexity effect. Okay student, just before I proceed further, I think I have received query. 1 minute. Sumit Jain is saying, sir, why this by this formula answer can be verified. Of course, Sumit, the answer can be verified, but my request to you, in examination the time is very limited. Of course, if you have any doubt regarding better approach is this approach, just you apply the straight way. You not to apply the formula, then you verify the figure, because it will take consume your precious time in examination. You can go straight here there, this adopt this formula, not a formula, this approach there, and just get the answer. Okay, just do it very consciously, no figure should be wrong, and go proceed further. Okay, so this is I think this is convexity effect must be clear to you, and the formula has been given in the study material. Okay, now student, I am coming to the next aspect. This is very important, bond immunization. Actually, this concept is very important because what happens whenever we invest the funds, normally bonds are affected by two type of main risk. One is price risk, another is reinvestment risk. Okay, price risk that we have discussed, when the price, suppose if interest rate changes, increases, then our prices of the bond will fall. But what we get the benefit of reinvestment. If we suppose after 1 year my FD is maturing, so of course I will get the benefit. So there has to be a, these both risks are conflicting with each other. So we have to find out one way out, and that is called immunization or bond immunization, because this is particularly important in case of a pension fund where they have to invest the funds. So this one numerical is also there. You just refer it from the study material. Now next I am discussing with you a yield curve or term structure. Student, this yield curve and the term structure are two important terms, is more or less same terms. What happens, yield curve mainly, it is based on one very logical reason that if we go for an investment for a long period, of course we shall expect more interest rate. And this happens normally because some risks are attached with it, like liquidity risk and default risk. So of course, for in addition to that, we get a premium. So if I say you, I just simply give you an example. If I say you, if you invest the money for the 1 year, I will give you the rate of interest of 6%. You invest the money for the 5 year, I will give you the rate of interest of 6%. You will be you ready to invest in this 5 year? No, because you want some compensation for the uncertainty for this long 4 year period, and that is the premium. That is the premium for the longer duration. So normally you may say, okay, I will need the 7% or 7.5%. So on that basis, if we draw out the yield curve, it takes the shape like rising yield curve. It is called rising yield curve. Now here it is the time and here it is the yield. Okay, student, and normally this happens. Normally this happens. Okay, now next I'm coming to the, now I'm just, this is the one shape. I'm just discussing with you another shapes. Now there is another approach. This is called downward sloping or inverted yield curve. Here opposite happens. Second. I think I have drawn the yield curve reverse way. Sorry, student. Earlier was this one, rising with the time, or I was saying here just. I think yeah, I have maybe I have placed the wrong. With the passage of time, it is the, this is the proper. I think I have reversed that. This is a figure I have. I think I have used wrong figure. No problem. The first that was figure was for the rising yield curve. Okay. Now here I am saying your falling yield curve. Okay, downward sloping. Here it is a YTM or it is a period. Okay, now what happens with the increase in the period? The yield is coming down. Okay, now what happens, student? Please note, this is a symbol of recession. When the people are more interested in the short-term securities, and this practically happens recently, because it has happened in the recently, and there was some, if you refer the newspapers, etc., there was some symptoms are like that the recession of 1929 may come back in the USA, because at that time what is happening, the preference is investing for the short term money, and that's why it is going on a premium. Okay, so that's why the short duration, this is a yield curve is there. So this is called our, and there is another version is a flat yield curve that I've discussed, 6% for, this is called flat yield curve, but it rarely happens. Okay, then there is another version, humped yield curve. First it may go like that, or it may, we can say that initially it may go down, then again it shape. Sometimes it may also help. So this is called humped yield curve. So student, this was discussion about our yield curve. I am sorry, I have taken this wrong yield curve. Now then there is a term structure theories. Okay, just you refer from the study button. Now I am coming to one of the most important, that is convertible debenture. Now student, it is very important what is convertible debenture. I don't know this is give more any theoretical aspect on the same, but I will discuss with you the financial aspect. Now what is convertible debenture and why it is important? Now student, it is important because sometimes we may be interested in acquiring the equity of any company, but they may not be available, it may not be available in the market. So we can take the conversion route. Okay, we may take the conversion route. We may go for the convertible debenture, buy it, okay, and get it converted into the equity shares. So this is called conversion route. This is called conversion. When we take this conversion route, so now what are the important terms that are associated with it? First of all, the conversion value of the debenture stock. Conversion value of debenture or stock value of bond means how much stock value it carries the bond. Market price of equity share into conversion ratio. Okay, means per share mark, and what is the conversion ratio? Because it will give, say, if I say a share is currently trading at 400 and the bond debenture give me the right, get it converted into the 10 shares. Of course, the value of this debenture from market point of view will be 400 rupees. Now, next is market conversion price or conversion parity of the stock. Now, sometimes we may ask a question. I think you were completed only. It means either you go for the market or you take a conversion route. So this price that you either you buy it from the market or you make it conversion route. So that we can compute means market price of convertible bonds divided by conversion ratio. Continuing to take my example here. Now here's 10 shares can be converted. Okay, suppose it is the debenture is trading in the market. Okay, the debenture is trading in the market at 3,800 rupees. Okay, what I will do, I will go to the market, I will pay 3,800 bucks and just get it converted into 10 shares. I will get 10 shares. Each share is costing me 38 rupees. And what I will do, it is selling in the market 40 rupees. I will get the 2 rupees benefit without doing anything. Okay, if I am purchasing one debenture, my profit will be C20 without any investment. Okay, when this will start happening, of course, the price of the debenture, the supply is less, demand is high. Of course, the price of the debenture will go up, and it will ultimately where it will reach to 4,000, because either I go for a conversion route or either I go for a market route. The same thing will be. This is called conversion parity price. Now, student, you see, you know to cram these formulas at all, you just understand the terms, then certainly you will drive the values yourself. Now, next is conversion premium per share. As the name implies, how much premium I am paying due to this conversion route. This is, simply speaking, market conversion price because I have taken the route of market conversion minus market price of equity share. Okay, suppose again I am taking the example, if I have paid 380 only and market price is 20, so it means I am not the premium, rather I have taken the discount. Okay, student. Now if I have paid, suppose I have paid the price of say 4,200 of because of this conversion, and it is trading at market, it is 400, so of course I am paying the premium. Here it is a premium, here it is a discount. Okay, student. Now next I am coming to ratio of conversion premium. Conversion premium per share. Very simple. Ratio of conversion premium means how much I am paying above the market divided by market price. So you know to cram this formula. Again, I am telling you. Here the premium is 20. It is trading at 400. So it means I am paying a premium of say 5% because of this conversion route. Okay, student. Now I am coming to next term. Premium over the straight value of the debenture or the bond. Market price of convertible debenture divided by straight value of bond minus 1. Now student, question arises, what is this straight value? Straight value means if we buy the debenture and keep it up with us till its maturity, this is called straight value. And when we are keeping it for the till its maturity, of course we are getting its coupon rate, coupon, and of course maturity value. Okay, now if I get it discounted by YTM, this is called straight value. So it means, as I indicated, premium over straight value of bond. So it means if because bond conversion, because of this conversion, it carries the premium, because this market price of the convertible bond may be more than your straight value. So we can compute the in a percentage term. Next term is favorable income differential per share. Coupon interest from debenture minus conversion ratio into dividend per share upon my conversion ratio. Basically, what happens if we keep the coupon dividend debenture with us? Of course, we shall get the interest. Okay, every periodically we will get, and if we go for a conversion route, we get the dividend. To make them comparable, that in how much time we can say that how much interest we are getting more. Okay, so we use this formula. Okay, now next is premium payback period. Conversion premium per share. Vivek, how much time you will take this securitization? Because if it's possible, then we can 5 to 10 minutes. Okay, then I will, after this, I think we should switch over to securitization. Conversion premium per share. Favorable income differential per share. Okay, student. Now last I'm discussing the one more term, then I will percentage of the downside risk. It is very important term. As a name indicate, you will understand it. Market conversion price of the bond minus straight value of bond. Now student, please note, sometimes we may have an apprehension in our mind. Okay, I am purchasing this debenture. This debenture may be of 500. Okay, because say continuing our same example, I'm just discussing share. Okay, I forgot it. Example has been. Now suppose I think it was somewhere. It was 400, 4,000 price was there. Okay. Now it was convertible into our 10 shares. So it was market convertible price of the debenture. Now, if the straight value of the debenture is say 3,500, so what happens below it? Because please remember, the value of a debenture will not go below this straight value. In any case, you will get this much of benefit. This is available in the market. So we can say it is also called, you can say it is a floor value, below which you will not, this value will be there. So I hope this is clear to you, and we can compute the its percentage. Okay, percentage of the, because it is not about the risk hour is only limited to that percent. It cannot be go more than it. So I hope with this it must be clear to you. Only last thing I am discussing with you, there is one term in the study material has been written, that is zero coupon bond. Student, please remember, there is one term I am discussing with you. Zero coupon bond is also called strip bonds. Okay, the full form is separate trading of registered investment interest and principal securities. Student, what happens when a coupon bond is divided into two parts? Once it is sold as a coupon rights only, and principal is sold as a discounted value, so then it becomes your zero coupon bond. Okay, students. So with this, I hand over. Although I have to discuss the portfolio management, but seeing the paucity of time, Vivek, I think you start with this our securitization topic.
Okay, securitization. In simple language, securitization can be said that it is converting the illiquid assets into marketable securities. And it is generally suitable for companies who need immediate cash but do not want to resort to borrowings. So, basically, I will try to explain this with the help of an example so that you can get a grasp of this. Some finance companies, or you can take the example of a particular bank. So it has continuing its lending business. It has lent to various borrowers, and the borrowers borrow the money and give their mortgage to the bank. So bank has mortgage-based assets. And those mortgage-based assets are illiquid. Why illiquid? Because the banks will receive the entire amount gradually, 5 years, 10 years, 15 years, 20 years. But the bank needs money from time to time. It needs more money because there are other borrowers in line also. So it has to continue its lending business. So where will this money come? So simple method in this case is securitization. So what it does is it sells those mortgage-based illiquid assets to a particular entity, which is called a special purpose vehicle or SPV. So it sold the mortgage-based assets to SPVs. SPVs in turn pay the cash. So the bank's job is done. It gets the money. It can continue its core business, that is the lending business. But the SPV, now it is the job of the SPV to get those mortgage-based assets converted into securities and make it marketable. It made it marketable through with the help of the credit rating agencies. So if a particular security got a good credit rating, for example AAA, then the investors will be ready to latch onto those securities. So it converted those securities, made it marketable with the help of the credit rating agencies, and finally issue it to the investor. So this is basically the simple concept of securitization. I will take the help of a flow chart to explain this, then I will continue further.
Just continue.
So let us take an example of a particular bank. The name of the bank, you can say XYZ Limited. So in our example, what it does is it actually sold its mortgage-based assets to SPV. Mortgage-based assets to SPV. SPV gave him the money. So it can XYZ bank can continue the banking business. Then the SPV converts the mortgage-based assets into securities, made it marketable with the help of credit rating agencies. For example, the securities got a AAA rated credit rating. So security has been made marketable. Then it is issued to the investors. This is the simple concept of securitization. So what is the benefit of this securitization? The benefit of the securitization is that the XYZ bank, which is in need of money, which has huge illiquid mortgage-based assets. So it sells those mortgage-based assets to SPVs, get the cash, continue its core lending business. SPV then convert those illiquid assets into marketable securities issued to the investors. Investors got the good securities. They got a diversified portfolio because these mortgage-based assets refers to different types of, you can say, relate to different types of sectors. So you can say the investors got a safe and a diversified portfolio because of that. Everyone get benefit of this. The credit rating agencies got some commission out of this. The entire this securitization process managed by the merchant bankers. They got a fee for this. Special purpose vehicles, which converts those mortgage-based assets into the marketable securities, also got a particular fee for this. So everybody is happy with this particular securitization process. So how the investors will get the money? The various borrowers will pay the interest to the XYZ bank. Bank will just pay to the SPVs. Then SPVs will finally pay to the investors. The investor will receive the money by this. So this is the simple concept of securitization. I will move further. And now come to the benefits. You understand what securitization is. What is the benefits of the securitization? The main benefit is it is an off-balance sheet form of financing. Why off-balance sheet? This is off-balance sheet because the financing is done without disturbing the liability side of the balance sheet or without increasing the borrowings of the companies. How? Because when the bank, in this particular example, sold its mortgage-based illiquid assets, the assets have gone out, but when the SPV pays cash, the cash is coming into the business. So there is rejigging in the asset side of the balance sheet, but liability side is not disturbed. So it is an off-balance sheet form of financing. Another benefit, a major benefit, is that the bank in this case, or in the originator, in the securitization term, it is called the originator, which originates this process. So in this example, the bank can continue with its core business, that is the lending business. And what is the benefit to the investor in this securitization process? As I mentioned before, he gets a diversified portfolio because those mortgage-based assets relate to securities, which mortgage-based assets relate to various sectors. So he got a diversified portfolio in this. Now, who are the participants in this securitization process? First is the originator, the bank or the financial institution in this example, and then the special purpose vehicle, which converts those mortgage-based assets into securities. You can say another participant is the merchant banker, which manages this securitization process, means those securities issued to the investors. Then there are credit rating agencies which make this securities marketable. And then finally the investors to whom the securitized instruments have been issued. So these are the major participants in the securitization process. The mechanism of securitization, as I have just explained, the originator, that is the bank, issued the mortgage, sell the mortgage-based assets to the special purpose vehicle. Special purpose vehicle pay the cash to the originator. Then the special purpose vehicle converts those mortgage-based assets into securities, made it marketable with the help of the credit rating agencies, and issued to the investor. This is probably the mechanism of the securitization. Now, what are the problems in securitization? I have just gone through the various benefits. The benefits are numerous, but there are certain problems also. The problem is basically the stamp duty. The stamp duty in the securitization is still very high in India. Another is the problem is the taxation aspects. Some confusion arises as to whether the SPV as a trustee should be taxed or whether the investor should be taxed. So there is some less clarity on this taxation issues. Then there are accounting issues also. True, the securitization is a off-balance sheet form of financing, but the receivable of the originator are actually the moving out. No. So if the securitization process is on transferred without the recourse basis, then it is actually the problem. If it's the recourse basis, means if you can say the borrowers are not able to pay the interest to the originator, the bank in this particular case, the bank will not be able to transfer those interests to the investors of the securitized instruments. So if this is on recourse basis, the problem arises with the now comes to the originator, the bank. The bank has to make good the money. So if it is a non-recourse basis, then the originator is not responsible in such cases. So there are some accounting issues in securitization also. Then there is lack of standardization, that there is no standardized document or standardized format in which the securitization contract can takes place. And last but not the least, there is an inadequate debt market in India, as you know. That is why the securitization process has not been, you can say, scaled up in India as it is in the Western countries. So now I will come to the you can say the securitized instrument, which is also very important. There are major, you can say, three types of instruments are there. This is first one is the pass-through certificates. Pass-through certificates are nothing in which the investors of the securitized instruments are given certificates by which they get periodic interest on whatever investment they have made in the securitized instrument securities. Pay through securities is different to the you can say pay through securities is different in relation to the pass through certificates. In pay through securities, interest are not given, but new securities are issued to the investors. And then there are stripped securities. Stripped securities, there are two aspects: interest only securities and principal only securities. For example, an investor wants to opt for interest only securities, then only interest will be given to such investors. And if the investor opts for principal only securities, then the interest will not be given, only the principal amount will be returned to.
That just have discussed in the bond valuation.
Yes, sir. So this is what about the securitization India. As I've just also explained, that securitization India has not took as well as it is in the Western countries. So you want to take
no, okay, it's over now.
Okay, sir. So securitization, this aspect is covered.
Okay, students. With this, we come to this end of this session, and I hope whatever has been covered in the session must be very much helpful to you for your examination. Of course, student, we shall continue the session tomorrow at the same time. Maybe we take up some extra thing in the session. So meanwhile, if you have any queries, as Director BoS Studies has told you to just post your queries, we will of course reply you in the session, also in the forthcoming session. And as usual, just keep preparing, and please don't pay heed to the rumors, and just prepare yourself, and please be fearless and be confident for your examination. Okay, student, all the best. See you tomorrow at the same time. Okay, have a nice day.
Thank you so much.